DeWaal here, and this is Bridging the Week for October 5th to 9th, and today is October 12th, 2015. Good morning. Enforcement actions, not regulatory proposals, occupied center stage in financial services last week. The Securities and Exchange Commission charged the trader and his firm with spoofing after the trader's complaints of spoofing by others apparently went unheeded. While both parties to a criminal case alleging spoofing on CME Group exchanges and ICE Futures Europe in 2011 fine-tuned their arguments in anticipation of the commencement of a trial later this month. Meanwhile, United States presidential candidate offered her vision of enhanced regulation of financial services firms and markets. It may be Columbus Day holiday today in the United States, but we still have a lot of interesting stories to cover, so let's get started. Eric Osher and Briargate Trading, a company 50% owned by Mr. Osher, agreed to pay an aggregate fine of $500,000 and disgorge profits of $525,000 to resolve charges brought by the Securities and Exchange Commission that they engaged in prohibited spoofing activity involving securities listed on the New York Stock Exchange from October 2011 through September 2012. According to the SEC, during this time, Mr. Osher caused his company to place a series of large, non-bona fide orders to buy or sell certain stocks prior to the New York Stock Exchange market open. The intent of these orders, claimed the SEC, was to drive the price of the stock up or down in the pre-open period by contributing to a perception that there was a large buying or selling interest. Briargate would then place orders in the opposite direction of its spoofs on other markets that listed the same stock but that opened prior to the New York Stock Exchange. After these bona fide orders were executed, Mr. Osher would cause Briargate to cancel its New York Stock Exchange pre-market open orders. He would then cause Briargate to liquidate its executed positions after the relevant stock price reacted to elimination of the large non-bona fide buying or selling interest. The SEC claimed that Mr. Osher began utilizing his trading strategy in October 2011 after he had complained to New York Stock Exchange, quote, that other market participants were engaging in manipulative conduct involving large canceled orders. For example, in the spring of 2011, Briargate complained to the New York Stock Exchange that the data feeds provided by the New York Stock Exchange were susceptible to manipulation, where parties looked to gain advantage by entering non-bona fide orders to entice others to trade, end of quote. With the scheduled criminal trial of Michael Coscia for alleged spoofing scheduled to commence 2 weeks today, on October 26, 2015, the U.S. Attorney's Office in Chicago indicated its intent to narrow its theory of the case, while both parties made motions to prevent the other side from introducing during trial evidence and arguments they claimed might inflame and distract the jury. Mr. Coscia, who was subject of and settled civil enforcement actions brought by the Commodity Futures Trading Commission, CME Group exchanges, and the Financial Conduct Authority for alleged spoofing activities involving futures traded on CME Group exchanges and ICE Futures Europe from August through October 2011, was indicted in Chicago in October 2014 for some of the same transactions. Although Mr. Coscia had been charged in his indictment with engaging in conduct that, quote, is of the character or known to trade as spoofing, end of quote, paralleling the relevant provision of law, the U.S. Attorney's Office advised the relevant court that it only intends to prove that each transaction, quote, unquote, is spoofing. According to the U.S. Attorney's Office, this decision will streamline the trial. The U.S. Attorney's Office also requested the court to bar Defendant from introducing evidence or arguments related to possible vagueness of the relevant spoofing law, or regulations or interpretations of the CFTC, FCA, CME Group, or ICE related to spoofing. Mr. Coscia similarly made a motion to bar the government from introducing evidence or arguments related to regulatory investigations into defendant's conduct and his settlements, alleged market harm or disruption that is unrelated to Mr. Coscia's trading activities, any reference to manipulation, lay witness descriptions of defendant's trading as spoofing, and complaints by non-testifying market participants regarding Mr. Coscia's trading. Mr. Coscia settled his civil enforcement actions for aggregate sanctions in excess of $3 million US, disgorgement of $1.3 million US, and trading suspensions. Presidential candidate Hillary Clinton laid out her populist vision of financial services regulation in a position paper entitled Wall Street Should Work for Main Street. According to Ms. Clinton, the Dodd-Frank Wall Street Reform and Consumer Protection Act was a good start to enhance oversight of the financial services industry, but more needs to be done. Among other things, Ms. Clinton called for imposition of margin and collateral requirements on repurchase agreements and other securities financing transactions, a high-frequency tax on firms trading with quote-unquote excessive levels of order cancellations, ensure that individuals are held accountable for corporate breaches of law, prevent banks from investing up to 3% of their capital in hedge funds as currently is permitted under the so-called Volcker rule, and encourage other worldwide financial centers to impose regulations as tough as those in the U.S., quote, leveling the playing field for U.S. firms and safeguarding global stability, end of quote. Let's see where this all goes. And finally, 3 private equity fund advisors, Blackstone Management Partners, Blackstone Management Partners 3, and Blackstone Management Partners 4, settled charges brought by the Securities and Exchange Commission that they failed adequately disclose in advance a certain fee they charged the funds they managed, as well as a legal discount they received but did not pass along in its entirety to the same funds. To resolve the SEC's complaint, the respondents agreed to pay a total fine of $10 million and to disgorge profits of over $26 million plus prejudgment interest of almost $2.7 million. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. Well, until next week, this is Gary DeWaal. Have a great week. Enjoy today, your Columbus Day parades, and ciao.